Welcome to our channel, Finance Experts. Investing money can be a difficult undertaking, especially for individuals who are unfamiliar with a range of investing alternatives. Stocks, bonds, and mutual funds are just a few of the many investment vehicles that are accessible. Before making any investments, it is crucial to carefully weigh the advantages and disadvantages of each option. We will examine the benefit and drawbacks of several investing vehicles in this video, with an emphasis on stocks, bonds, and other well-liked choices. What are bonds? Bonds are instruments of debt that can be viewed as loans or promissory notes. The fundamental concept behind a bond is that an organization has to generate money and can do so by selling a bond in exchange for the needed funds. They agree to pay interest on top of the principal borrowed in exchange. Interest is the compensation rate that the investor, in this case, the lender, demands. Because they offer a predetermined amount of return in the form of interest, they are also known as fixed income instruments. When you buy a bond, you are giving money to a company or the government, and they agree to repay you with the interest and the principal. Bonds often carry smaller risk than stocks do, but they also typically offer lower returns. What is stocks? Stocks are equity securities, and purchasing them can be viewed as acquiring firm ownership. Stocks, on the other hand, are issued through sole proprietors, partnerships, including corporations. An organization that needs to raise money can do so by selling stocks or shares, which will provide the necessary capital. In exchange, the business provides the investor a stake in the business that entitles them to excess profits and allows them the ability to participate in ownership choices like voting on management. Stocks do not offer a fixed rate of return, in contrast to fixed income products, and their yield might change over time. Do you know? You are purchasing a minor stake in a corporation when you buy a stock. When a company succeeds, the stock's value rises, allowing you to profit when you decide to sell it. Additionally, stocks distribute dividends, which are ongoing payments to shareholders. The potential for significant profits, liquidity, and the chance to receive dividends are all benefits of stock investing. Stocks are recognized for their volatility, or the ability to experience significant price changes quickly. In addition, there is always a chance that business failure will result in a drop in stock price. Now let's take a look at some of the other main investment methods. Cryptocurrency. Cryptography is used to secure digital or virtual currencies, such as cryptocurrency. Bitcoin is the most well-known and popular cryptocurrency. The potential for big returns, as well as the fact that cryptocurrency is decentralized and isn't governed by any institution or government, are advantages of investing in it. Furthermore, cryptocurrency transactions are quick, safe, and reasonably priced. The drawbacks of investing in cryptocurrencies include their high volatility and risk, lack of regulation, and complexity in navigating the market. Mutual funds. A type of investment vehicle known as mutual fund pools the funds of numerous individuals to purchase a range of stocks, bonds, and other sorts of securities. The opportunity to invest in a number of assets without having to acquire them separately is one advantage of investing in mutual funds. Diversifying your portfolio can also help to lower risk. Additionally, experienced money managers who act on behalf of the shareholders of the fund administer mutual funds. The high management fees associated with mutual funds, which can reduce your profits, and the fact that you are liable for the performance of the entire fund rather than just specific assets, are some of their drawbacks. These are considered some of the most common investment methods in the present world. Now let's take a look at the difference and pros and cons of them. Pros of bonds. 1. Fixed returns for investors by bond. Everyone would like to be able to invest their funds and to know with assurance where they will be at some stage in the future. On the contrary, bonds will provide investors with a guaranteed annual rate of return. The amount that investors will be reimbursed for the use of their funds in predetermined intervals, typically annually or semi-annually, is known as the bond's coupon rate. These don't fluctuate always as stocks. For instance, if an investor invests $10,000 in corporate bonds of a corporation with a 4% yearly coupon rate, they will receive a $400 annual yield on their investment. 2. Bonds are less dangerous in contrast to other investments. When investing their money, investors seek an established rate of return as well as a low-risk environment. In light of this, bonds are theoretically the safest investment choice if you exclude FDIC-insured savings accounts with their pitiful interest rates from the definition of investments. Since bonds are a type of debt, the company that issued them is obligated by law to reimburse bondholders for the use of their funds. 3. Bonds offer superior returns to bank investments. As previously stated, there is little interest earned on funds held in FDIC-insured checking or savings accounts. The money in bank accounts is usually losing purchasing power over time because inflation normally ranges between 2% and 4%. Even though some municipal bonds do not have great yields, the return is still much higher than keeping your money in cash or a savings account. Cons of bonds. 1. Bonds require a higher investment amount. Large-scale, multi-million-dollar public or private projects are frequently financed via bonds. As a result, even the lowest valued bonds issued for such projects may cost $5,000 or $6,000. Given their capacity to buy fractional shares of their preferred stock for a little as $1, some investors may find bonds to be out of their price range as a result. 2. Bond liquidity slowdowns behind that of stocks. Stocks are not an asset with perfect liquidity. The majority of stocks may now be bought and sold in a matter of seconds because of the widespread use of ECNs. In contrast, the liquidity of bonds is extremely low. The principal of the investment won't return to the bondholder until the bond matures, which often happens 10, 20, or even 30 years down the line. Pros of shares. 1. You don't need a lot of money to start. Additionally, you don't have to be wealthy to increase your money through stocks. You can start by putting aside as much money as you can over a period of months, and then invest in a small number of shares of stock or an exchange-traded fund, ETF, that tracks the stock market like the SPDR S&P 500 ETF or SPY. If you continue to do this over time and increase the size of your investments as you are able, your assets ought to optimally expand. If you currently have very few resources, consider purchasing stock fractions. 2. You have rapid access to your money. Another benefit of stocks is liquidity. You can simply take out all or part of your worth from some investments like real estate right away or quickly. The process of listing and selling a home might take weeks or longer. Alternatively, you could apply for a loan using the property as security. But with stocks, you can purchase and sell them whenever the market is open during the week. The fact that you can sell shares rapidly does not necessarily indicate that you should. It is important to remember. 3. There are stocks available for everyone. Another benefit of stocks is the wide variety of stocks available, each linked to a distinct type of company. Even though it's not advised, you can invest all of your money in exciting startup businesses. There are also many huge, well-known dividend payers which you may prefer. You can also concentrate on a variety of areas, including the financial sector, software developers, and the energy sector. In order to prevent putting too many eggs in one basket, it is generally advisable to diversify among a variety of businesses and industries. Cons of stocks. 1. The financial markets are unpredictable. Recognize the volatility of the stock market as well. It has always increased with time, but not linearly. Along the process, there will undoubtedly be corrections and crashes, and you must have the courage to not panic and sell in a hurry. 2. Even if you have experience, you will still lose some money. You can expect to lose money occasionally because of the market's unpredictable character, the reality that everyone makes mistakes, and the fact that sometimes even carefully thought out investments don't turn out as expected. You can either be ready for that or avoid investing in stocks. Savings accounts, certificates of deposit, and other less dangerous investments can provide assured earnings, but they are unlikely to increase very quickly, while not having your money grow as you need it to is also somewhat risky. Did you gather the maximum knowledge on what are the best investment methods and what are the main pros and cons of those investment vehicles? Thanks for being to the end of the video. Don't forget to like, share, subscribe, and tell us what you think about this video below in the comment section. Thanks for watching, and we'll see you in the next video.